What's up everyone, it's Karthik with Money West. Welcome on board for our live stream for the last and final FOMC meeting of 2024. And this is the last time Jay Powell is going to be talking in 2024. We've come a long way. The entire year has been full of roller coaster, full of a lot of emotions, a lot of really interesting days, interesting events and catalysts. And so far, of course, the markets have powered through to all-time highs, trading near all-time highs, including the likes of a lot of individual stocks. If you guys can see me and hear me, I just want to make sure the audio and the video is good. Just give me a thumbs up in the live chat, and we should be good to go here with QQQs basically flat ahead of the Fed meeting, and we got Nvidia now pushing higher. Very nice recovery, back up to over 136, so it's up a little bit over 4.4%. And we got Palantir up almost 4%. Tesla is struggling on the day, although it did hit a new all-time high of well over $488. It is starting to roll over just a little bit over 70 basis points. And semiconductors are seeing a very nice recovery back up. We're seeing a nice little push up in SMH. It's up over 1.5%. With volatility, which was up over 11% yesterday, is rolling over on the day today. It's down a little bit over 4.6% on the day as well, and market breadth continues to absolutely get destroyed, and we've got fewer and fewer stocks trading above their moving averages. And now you can already probably guess which those companies and which those stocks are. Those are your magnificent 7 stocks, of course, all the big tech top 10, top 20 stocks that are trading above their moving averages. They're the ones that are actually keeping this market pretty elevated to near all-time highs, but majority of stocks are trading below their moving averages. So the technical weakness has been very, very strong. So perfect. Thank you so much for joining, everyone. Audio is good, and we are ready to go. The statement's going to be released in about 30 minutes. So that's going to be the summary of economic projections. And this is going to be a meeting accompanied with the summary of economic projections. So we'll see what the expectations are from the Federal Reserve for 2025, 2026, and I think they're also going to be including their 2027 projections as well. So in the past, you'll notice that we actually had 2027 also, so I think we're going to see that, as well as might even be 2028, because I think they might just drop off their 2024 target since it's the last meeting, and we're pretty much done with the year. So I think it might be 2025, 2026, 2027, and 2028. And then, of course, longer run targets for the Fed. So, but the most important number is going to be 2025. So that's going to be perhaps the most important number. That's the federal funds rate that we're going to be focusing on here. That's the number to look at right away. As we already know, the Federal Reserve has decided to, or not really decided, but the markets are very much pricing in for another rate cut for this meeting. So if you open up the FedWatch tool, which is again what's tracking markets expectations, you'll notice that we have about a 90+% probability that we're gonna get a 25 basis point rate cut, 98% probability. So markets pretty much decided and done the work for the Fed already. But in 2025, you can see that the markets are pricing in for 2 rate cuts, and the Federal Reserve in their last summary of economic projections basically told us 4 rate cuts. So there's a couple different numbers that I really want you to focus on as soon as 2 p.m. hits, and then 2:30 p.m. of course is the speech. But we've got about 20 minutes or so until 2 p.m. until the statement and the SEP comes out. Folks, do me a favor. Please make sure that you drop a like and share this live stream with as many people as you possibly can on our Discord, on WhatsApp, Facebook, Telegram, anywhere where you have connections, friends, family, other traders, investors, so we can have more and more people join us for this live stream, because it is a very, very important and decisive day. This is also a meeting where Jerome Powell could be addressing a lot of political questions. I'm sure there's going to be a lot of questions around Trump, around the new administration, and what might look like the 2025, 2026, the next 4 years might look like for the U.S. economy and, of course, for monetary policy. So it's going to be a very important meeting. So do me a favor and share this live stream so we can have, like I said, more and more people join us for this very important stream as the Federal Reserve pretty much embarks on this last and final FOMC meeting. So I've shared the link, just copy and paste it so we can have a good engaging discussion here. We've also got a poll right now going on whether the markets are going to be hitting new all-time highs or going to take a dump after Powell's speech. So statement comes out at 2 p.m. So that's going to be just about 20 minutes. Summary of economic projections is going to be accompanied with the statement, and then the speech is going to happen at 2:30 p.m. Eastern. So 2:30 p.m. Eastern is when the Jerome Powell speech begins. Usually lasts for about 30 to 45 minutes. It's going to end around about 30 minutes before the markets close. And so we'll see what happens with the markets, of course. And, just to go over the calendar, you'll notice that today is December 18th. By the way, thank you so much for Kevin for the gift. And, okay, so we probably, I think, already hit our goal. I don't know if we did, but we're trying to get to our goal of 5 gifts or chats or something because YouTube started this new feature, and I will do just a quick Q&A towards the end of the live stream if we're able to hit that goal. So we'll definitely do that. But this right here is the calendar. So December 18th, this is today. This is the Fed meeting. Tomorrow, regular trading day. On this Friday, I think we've got the triple witching, where we've got a lot of options expiring. So you'll notice S&P 500 rebalance for 400, 500, 600 rebalance on the third Friday of March, June, September, and December. And then we also have the triple witching effect this Friday, where there's going to be a lot of stock futures, index options, stock options all expiring at the same day. That's going to be this Friday. I have an SOXL put that also expires this Friday. And then next week is going to be a shorter week because 24th is going to be Christmas Eve. So market's going to close at 1 p.m. And then 25th, we've got Christmas Day. So it's going to be a shorter week. And then, of course, we got 2 more days left for Monday, Tuesday. That's 30th and 31st December to pretty much close out the entire month, the entire year, and it's gonna be quite interesting. And we're also gonna be doing our private live stream towards the end of this year to close out the year, go over all the performance and go over what 2025, what are some of the things we need to be focusing on. So we'll be doing that private live stream for all the members as well. So what do we have? We got 1, 2, 3, 4, 4.5, 5.5, 6.5, 7, 8. There's about 8.5. If you take today also as a half day, we really have about 8 trading days left in the market for 2024 and for December. And again, today, very, very important meeting from the Federal Reserve, with the markets fully pricing in for a 25 basis point rate cut. So if you take a look at rates and where they are, the rates right now are sitting at 4.5 and 4 3/4. So that's 4.25 to 4.5%. Percent is what the expectations are. So we're going to be looking at this number right here. So as soon as I open the statement at 2 p.m. Eastern, we're going to be reading this line first very quickly to take a look at whether the Federal Reserve decided to cut rates or not, which again, there's a 98% probability the markets are pricing in for a rate cut. And we're going to be seeing the federal funds rate, potentially getting cut by a 0.25 percentage point and coming down to 4 to 4.25%. So that's going to be the target, is what the market's pricing in for. So let me just hold on. Does that lower range for federal funds rate by a 0.25 percentage points to 4.25 and 4 3/4? Okay, so 4.25 to as much as 4.75. So that's the 50 basis points worth of range that the Federal Reserve was bringing the rates down to. So we'll be taking a look at that. And then, of course, coming over with the summary of economic projections, that is also going to be accompanied. And the first number we're going to be focusing on is, of course, the 2025 number, and what is the Federal Reserve projecting for the next several years when it comes to interest rates. So coming back over to the markets, Tesla here is still struggling quite a bit. We're down a little bit over 1.5%, I think for the right reasons, because Tesla has been just on this massive run up. It's just gone absolutely parabolic, as you can see over here. We had a nice little run up after the election, then a little bit of that pullback, consolidated sideways, and the last several days have just been insane for Tesla since towards the end of November, and all the way till now. It's 47% higher. And month of December, it's up 36%. November was up another 38%. So 2 back-to-back very green months for Tesla. And I think a lot of that liquidity is flooding back into NVIDIA. NVIDIA certainly has been struggling quite a bit. From its highs of $152, it sold off over 16-17%. It was in a quote-unquote correction territory. And right now we're seeing some buyers finally stepping back in. It's up a little bit over 4% at the moment. So coming back above that support of 130s. And of course, the markets overall having a very strong year. QQQs year to date are up over 31, almost 32%. And of course, we know the S&P 500 is up well in the 20s, 27.5%. So two back-to-back very strong years for S&P as well. So we got over 550 people watching, everyone. So 279 votes. We're hoping for at least getting up to over 500 votes for what you're expecting from the markets after Powell's speech. Is there going to be new all-time highs, or are we going to see some dumps in the market? So let me know in the polls here, and we are going to be ready. So about 15 minutes left for both the statement and the summary of economic projections to be released. So get ready, as it is going to be a very interesting day. So one thing that I'm kind of curious, okay, 4.5. Okay, I was kind of reading it differently. Okay, my bad. So 4.5 to 4 3/4. For some reason, I was kind of reading this as 4 1/4, but this is 4.5 to 4 3/4. Yeah, I'm still dealing with a jet lag. It's been well over a week since I've been back, but man, I just can't not sleep in the afternoon. I just always cave in the afternoon for a couple hours when it's like 2 or 3 in the morning. And it's always worse when you're coming back. It's always worse when you're flying east versus when you're flying west. When I'm flying west, there is no jet lag. I literally don't even feel anything. I just kind of, I'm right back into the routine. But when I'm flying back east, when I'm coming back home, it's just really bad with the jet lag. It takes me at least a month, in some cases more than that, to get back into the routine of like sleeping properly at 8 hours at night, and then of course having a lot of work getting done in the day. But right now I'm just still struggling. So getting like about 4 or 5 hours at night here. Okay. Little Ricky says, buy the rumor, sell the news on January 20th. We learned about Tom Lee's predictions, and he said the first half of 2025 is going to be very strong. And then towards the back half of 25, he's actually expecting S&P to come down. He's expecting, I think, the S&P to, if I'm not mistaken, I think trade up to as much as 65 or 6,800, and then come down to like 63, 6,400. I could be mistaken, but I think those were the numbers that Tom Lee put out in his update. So, there's definitely going to be a lot of optimism going into next year with the new administration, with deregulation, with a lot of support from CEOs and businesses. And so I think that is going to really create this sentiment where a lot of capital could get deployed into the markets even further, more than what we've already seen. But yes, eventually we need to be very careful. And I think that's for those reasons I have been selling calls against the shares that I already have. I really narrowed down my portfolio quite a bit. I mean, it's really consolidated now to a point where, I really only have 8 positions open. And again, Tesla and VUG, SMH, Palantir are some of the bigger ones. And I'm just selling calls against those positions to kind of protect some of my gains. And so I think that's really the whole idea, is to kind of buff up the cash position, have a little bit more cash exposure to if and when the markets give us that opportunity. The Money Vest Index, let's say, comes down. I'm going to close out my YouTube here. But if we come down to, let's see, the Money Vest Index, there we go. So 3.41 is where we're trading. So we're very neutral at the moment. So the lower it gets down to, again, the better those deals are going to be for the market, right? So from a risk reward standpoint, the better the buying opportunities will be in the markets, of course. So keep in mind, this index, of course, volatility, and of course we got the shopping list. So the markets do give us those opportunities. We're going to be ready to take advantage of them. So Vault, what do you think about the market's reaction when we see rates for 2025 projected to be 3.8 to 3.9%? So, okay, if we come over to the summary of economic projections here, again, a quick reminder, we're sitting at 4.5 to 4.75%. And if the Federal Reserve decides to cut interest rates, we're going to be coming down to 4.25% and 4.5%. So that's going to be a 25 basis point rate cut. So that's going to be this expectations here, which the markets are fully pricing in for, over 90% probability that we're going to see a 25 basis point rate cut. And now the markets are pricing in for 2 rate cuts in 25. The Federal Reserve previously told us 4, but this right here is really the number that we're going to be focusing on. Now, If markets are pricing in 2 and we're going to be sitting at around, let's say, on the lower end 4.25, and then they're expecting 3.75 to 4%. So let's just call it 3.8 to be precise, right? 3.8, 3.9. That's going to be in line with the market vault, right? So your question about if the market see projected rates at 3.8, 3.9, I think that's going to be pretty much in line with what the markets are also pricing in. The market's pricing in a range between 3.75 and 4%. And so if that number right here goes from 3.4 to anywhere between 3.8 and 3.9, that's going to be in line with what the markets are already pricing in. So I don't see a huge reaction from the market. And then maybe the market starts looking into 2026, 2027, and then longer run targets. But I think that's not going to be a huge market moving event. Now, Federal Reserve speech, Jerome Powell's speech, is most likely going to be a much bigger catalyst for the market. So if we get a 25 basis point cut, along with the 3.8 and 3.9% print here, that's going to be in line with exactly what the markets are expecting. So in that scenario, we could see maybe a little bit of volatility, but not a huge reaction. But if this number stays steady at 3.4, or if this number is anything below 3.75, let's say call it 3.7, if this number is anything below 3.7, then I think the market's going to see that as a very good positive catalyst, and we could see some nice reaction from the market. Now, that initial reaction is always, in almost most cases, is a fake out. We've seen this happen over and over again, right? If the markets rally right after the statement and the S&P, in most circumstances, it starts rolling over as soon as Jerome Powell starts talking. And the opposite has also been true in the past, where the market sees a negative reaction initially. And then, of course, when Jerome Powell starts talking, the market starts to recover back up. So the first reactions almost always, not always, but almost always has been a little bit of a fake out for traders. And then once everyone's got the time to digest that report, read into it a little bit, that's when we start to see the real move take place with a lot of volume. So I would just be mindful. If you are trading into this event, just be careful, because nobody really knows how the markets might react. Even if you knew the numbers, we might still not know how the markets might react. And that's the beauty of the market, is that even if you could somehow know what those numbers might be, you might still not be able to trade accordingly, because we might still not know how the markets might react and which direction we might break out to. So this is the number to be focusing on, as well as, of course, the 25 basis point rate cut. But I think all in all, that's going to be coming in line with expectations here. And then the bigger question is going to be, what the Federal Reserve, what Jerome Powell ends up talking about during his speech, and what 2025 is going to look like from a monetary policy standpoint. I think the biggest challenge for the Fed is going to be keeping their independence, because as we know, Trump is going to try to interfere as much as he possibly can to try to maybe force the Fed to lower interest rates. But I do think that one of the things that the Federal Reserve is going to be really getting a lot of pressure for is not lower interest rates, but to buy bonds. I think that might be something. It's a little bit more of a passive QE, that this time around, this 4 years, I think it's possible that Trump, instead of actively forcing the Fed to cut interest rates, might force the Fed to maybe start buying bonds, because that's another way to control the yields. And yields have been out of control, as we already know. They've been pushing higher, back up to over 4.3, 4.4%, and really causing a lot of problems for lending rates across the universe of credit, right? So across the board, you look at auto rates, mortgage rates and credit cards and personal loans and corporate loans, everything's kind of pegged against the treasuries, more specifically the 10-year, because that's acting always as a proxy for where interest rates will be. And if that continues to go up, that's going to put more and more pressure for the entire economy, right? It's going to really just create this, scenario where the credit is once again very expensive. And so that could be one of the things that it's kind of like a wild prediction I have, but it's possible that, the new administration tries to force the Fed to try to buy bonds here, as opposed to straight up lowering interest rates. And that's one of the reasons why TLT, TMF are like plays where I'm not really taking right now. I only traded TMF once, was able to make some nice profit and then get out of it, because it's very difficult to try to predict interest rates, especially when you've got so much interference from other parties. There's political interference. There's a lot of macroeconomic interference, and it's very difficult to really predict where interest rates are going to be. So just because the Federal Reserve is lowering interest rates doesn't mean that interest rates are going to continue to come down. In fact, if anything, we've seen the contrary of that exact belief, because the Federal Reserve has been cutting interest rates the past three meetings, they've already cut by 75 basis points. But what's happened with the treasuries? They've gone back up, right? They've gone back from 3.6 back up to 4.5. So it's almost 100 basis points worth of increase despite the Federal Reserve lowering interest rates. And so it is very difficult to try to time and really predict these macro plays related to interest rates. So be very careful with the TLT, TMF. TLT is a little bit safer, but TMF, definitely be very careful, because one wrong entry on a leverage ETF, the decay can really get to you over time, and you got to be very careful with those trades. Anyway, so we got about 5 more minutes until the big numbers, the big Powerball numbers come out, and we'll be ready to reload this page right at 2 p.m. Eastern to take a look at both the interest rate decision as well as kind of dissect the summary of economic projections. Folks, do me a favor, please drop a like, subscribe to the channel, and also do share this live stream. Let's see if we can get up to at least 1,000 viewers by the time the numbers come out. So we are less than 5 minutes away for these numbers to come out. It's going to be very, very important for us. This is a live stream I'm doing after a long time. I'm going to get back into it in 2025, just taking a little bit of a break because of all the travel that I've been doing and just super tired. But definitely share the live stream so we can have more people join us, and definitely do participate in the poll. We do still have about 35 minutes until Jay Powell takes the stage and starts talking for his last and final meeting of 2024. So why is Tesla down so much, Caddy? I don't believe in profit taking if it's going to be going to this high today. So I mean, it's not really down a lot. I mean, it's down less than 1%, and that's what the markets have kind of trained us now. It's even after Tesla rallying so much, a 1% or an 80 basis point red day can feel like a lot, right? It's not really that much. It's taking a little bit of a breather, but we'll see what happens throughout the rest of the day after Jay Powell starts talking and how the markets are going to do. So perfect. We hit our 1,000 people target, everyone. Make sure that you drop a like and subscribe. And we are so ready for this last and final meeting. Markets are trading near all-time highs. If you take a look at the market snapshot very quickly, this is going to give you an idea of the day. Semiconductors are clearly leading the way here on the back of NVIDIA, rebounding very nicely. Technology struggling a little bit. Retail, utilities, real estate, insurance sector, automobiles, pharmaceuticals, energy. Those sectors are hurting right now. Financial services and banking is also higher. But if you take a look at the snapshot, you've got Apple at all-time highs, 254. Everything else, most stocks are within a dip. Amazon's in a dip. Netflix in a dip. Microsoft's in a dip. Google's in a dip. Salesforce in a dip. Meta and Tesla also in a dip. The only 3 stocks that are in a full-blown bear market are AMD, Adobe, and Qualcomm. And NVIDIA is also in a correction along with Oracle. Those are the 2 stocks that are in a correction. Everything else is well within 5% of their all-time highs in a dip right now. So get ready. 3 more minutes left, and we are good to go. We've got 1111 as the number of people watching right now. So that is incredible. Thank you so much for joining, everyone. That's the magical number right there. That's 1111. So 1111 people watching this live stream. So again, thank you so much, everyone. It's been a phenomenal year, and I hope you're absolutely crushing it in 2024. And let's be honest, Google is finally in a dip. Yes, Google's been hitting new all-time highs. ASML with a very nice recovery also, $753. It was in my options portfolio. Then I basically sold it for a small profit because I really couldn't get up to 100 shares unless they did a split, because I didn't want to dump too much capital into ASML at the moment. But it's a very, very nice company, as I've already discussed in my previous updates, and it's obviously getting back up to over 750s now. So it's nice to see that it's also recovering very, very nicely. So we're seeing a nice little pop back up to over 2.5% for ASML. And I would put down like a next resistance somewhere closer to around here at 760s, kind of aligned with this previous support level for ASML. Anyway, so we got about 1:30 left, everyone. So let's do this. It is time. It is a very, very important day. It's the days that we live for, basically. I do believe that I think we're going to probably sit somewhere around 3.8 and 3.9% for this number right here. I'm going to keep the previous SCP open as well. This came out in September, just so we can also compare and see where we're going to be. And the live stream's live, so this is going to be starting at 2:30 p.m. Eastern, and we are ready with just about a minute left. I'm going to reload this page. As soon as 2 p.m. hits, we're going to open both things at the same time, but first we're going to be looking at the statement, and then we're going to be looking at the SCP. And then, of course, take a look at the market's reaction. We got QQQs right here. I'm going to open up the SPX down here. I got Palantir stock. I'm going to keep Tesla. And then, of course, I've got NVIDIA over here that I'm also keeping track of to see how it trades. And then, of course, we'll take a look at volatility as well. So last and final meeting of the year of 2024. This is the last SCP. I think 2024 may get dropped off from the summary of economic projections, and we may see projections out to 2028. I'm not 100% sure, but we'll see if 2028 projections are in this summary of economic projections, because we're pretty much done with the year and 2024 should get dropped off. There's no reason to be including 2024 projections in this summary of economic projections here. There we go. 4 more seconds, and we're going to reload this page. And we should be good to go here. Perfect. Let's see. It takes a couple seconds, obviously. No, not yet. Too excited. December is here. PDF opening up. This is December 18th. So they cut interest rates by 25 basis points, bringing it down to 4.25% and 4.5%. So 4.25 to 4.5%. And there we go. So this is the 2020. Okay, so 2024 is there. It's the same. 3.9%. It's aligned with the market. That's what we're seeing right now from the Federal Reserve. The market's right now seeing a little bit of a pullback. So we're seeing some selling pressure. So everybody who's joining us right now, 25 basis point rate cut from the Fed is what we just got. So in support of these goals, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4.25% and 4.5%. So again, another 25 basis point rate cut. That's a full 100 basis points worth of rate cuts in 2024. And when it comes to 2025 expectations, they saw a revision to the upside. As expected, it was going to be somewhere between 3.8 and 3.9%, and we came in at 3.9%. That means what? 50 basis points worth of fewer rate cuts in 2025, because earlier the Fed was expecting from 4.4 down to 3.4. That's full 1 percentage point lower, but now they're expecting from 4.4 to 3.9. So that's again 50 basis points worth of rate cuts, but also 50 basis points worth of fewer rate cuts, because originally they were expecting about 4. Now they're only expecting 2. When it comes to inflation, they've revised up their headline inflation number. I think that's going to be primarily due to energy, maybe rotating back up. 2.5% is what they're expecting. And then core PCE, they're expecting it to come down to also at 2.5%. So 2.5% for both headline and core PCE for 2025. Unemployment rate they're expecting is going to tick up a little bit to 4.3%. And GDP expectations at 2.1% is what the Federal Reserve is expecting. So we've got the markets with a little bit of a negative reaction. Again, the first reaction usually is, in my opinion, a little bit of fake out. We'll see if this gets bought up here anytime soon. But right now, certainly the markets are rolling over. I mean, the S&P is mostly flat on the day, and QQQs are slightly down about 27 basis points. We got Tesla here down about 1%. Palantir still up 4%. NVIDIA is slightly selling off, but still up close to 4% at the moment. Volatility is down about 3%, and the 10-year treasuries are pushing up just slightly over 50 basis points right now. So some of the big change really is the federal funds rate expectations for 2025, also revised up for 2026 and 27. So all across the board, we saw revisions for the interest rate projections for the next 3 years. And if you come down here, you've got majority of members expecting rates to be somewhere between 3.75 and 4%. So that's going to be 3.9. We only really had 4 members that are still very hawkish, that are expecting rates to be above 4% in 2025. And then just we had like 5 members expecting rates to be below 3.75, but majority members, you can see, were somewhere between 3.75 and 4%. So those are the expectations from the Federal Reserve. I mean, they have obviously changed these expectations quite a bit throughout the year because I really don't care much about the first 4 line items because these are all projections and expectations. But this is really what the Federal Reserve controls at the end of the day is the interest rate, the federal funds rate. And for them to revise this back up certainly means that they're not expecting inflation to come down anytime soon. And that's why this is a big revision to the upside, right? The headline PCE, they're expecting from 2.1 to 2.5. That's a 40 basis point revision where it's still going to be a problem, right, for the Fed. I mean, eventually they're expecting inflation to come down to 2%, but from 2.1 to 2.5 is a big revision, and same for core, 30 basis points. I think shelter is really one of the reasons why inflation is not really moving as per the Fed's expectations. So markets here, QQQs, NASDAQ more specifically is down about 30 basis points. We got S&P mostly flat. And we got Palantir still up. Tesla trying to move back higher. So it's going to be quite interesting if Tesla actually ends up green on a day like today. But we do have Jerome Powell's speech starting in about 20 minutes or so, 25 minutes. And we'll see what Jerome Powell has to say for all these numbers. So those are some histograms, some line charts, some probabilities, statistics to kind of help us understand what their expectations have been. But all in all, that is it. This was the last and final summary of economic projections. And as expected, not a big move because we got the 25 basis points and we also got the 3.9% for 2025. So all in all, it was pretty much on par with expectations from the market. So that was a pretty okay report. Nothing out of the ordinary, nothing too crazy, the markets to look into. Just going to read this a little bit further. Let's see. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. The committee judges the risks of achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of the dual mandate. And in assessing the appropriate stance on monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. Just want to see about the bond buying programs here. Undertake open market operations necessary to maintain the federal funds rate in the range of 4.25% and 4.5%. Roll over at auction the amount of principal payments from the Federal Reserve's holding of Treasury securities in each calendar month that exceeds $25 billion. So once again, they're rolling over. Okay, so this is actually, let's see, reinvest the amount of principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities received in each calendar month that exceeds $35 billion per month into Treasury securities to roughly match the maturity composition of Treasury securities outstanding. Is that new information? I just got to check the older statement as well. If I come all the way down from November 7th. Okay, so reinvest the capital. Okay, so that's not new. If you come back from September maybe, all the way down, just want to check one more thing. So, okay, reinvest. Okay, so they've been reinvesting for mortgage-backed securities, but not for Treasury securities when it comes to the agency debt. So whatever mortgage-backed securities mature from the Federal Reserve's balance sheet, they've been reinvesting all that capital up until a certain cap. But for Treasury securities, they've just been taking all that principal, letting it mature, and they're not reinvesting it back, which is why, of course, the Treasury yields have been pushing higher, back up to 4.4% because of the lack of demand. There's no demand from the Federal Reserve coming in anymore. But market's really taking a dump here. We got QQQs down over 70 basis points. S&P 500 now really starting to roll over about 40 basis points. And Tesla here down about 1.7, 470. And we got Palantir, NVIDIA, everything really starting to roll over with the volatility now green. It's up over 1%. So a little bit of a shift in the overall market right now with these numbers that are coming in. Inflation expectations are higher from the Fed. And again, fewer rate cuts than what was previously proposed. But this is already what the markets were pricing in. So I don't think this should be surprising to the market because we were already looking for 2 rate cuts. And if you guys remember, like we were talking about this on our channel, where markets are going to get realigned in terms of what the Federal Reserve is doing, because I don't expect 4 as many as 6 rate cuts, in 2025. But I think 2 to 3 rate cuts I think is a lot more reasonable, unless of course the entire inflation picture changes, and worse, unemployment picture changes. If unemployment starts to really creep up here, I think that's when the Federal Reserve is going to be more inclined to lowering interest rates a lot faster than anything else. So if unemployment gets up to, let's say, 5 or 5.5%, and there's more and more people unemployed, then you better believe it. There's definitely going to be a lot of pressure for the Fed to cut interest rates very fast to help support the economy. But then you get into this cycle of inflation, once again, getting inflated again, where you're going to see prices go back up again. So really, the Federal Reserve has a very difficult job in order to try to maintain the dual mandate, where they can keep lower interest rates, lower unemployment, and lower inflation all at the same time. It's very difficult to do that. So that's why they have to keep playing this game where they increase, lower, and that's what it ends up being. Okay, so again, if you have any questions, everyone, let me know. I'm gonna read up some of the comments here. DXI is breaking out. VIX is still red, but it just turned green. Google is, in my opinion, silently becoming AI leader. Look at Gemini 2.0. Deep research that it can do. It's just running. VEO2 is simply the best, better than CGI. Google will have an incredible 2025. Google's just got a huge cash war chest, and it's going to start dumping money into artificial intelligence and building quantum computing and, just building next level artificial intelligence services and products. And that's really what's resulting in a very nice, breakout for Google to new all-time highs of well over $200. So the market cap slowly and steadily now approaching like $2.5 trillion. And so I believe Google can hit $2.5 trillion fairly soon. Then I also think that Nvidia can get up to eventually $3.5 trillion as well. And then we got Apple and Microsoft, of course, on pace for $4 trillion very soon as well. And then, of course, Meta. Meta's also, very close to its $2 trillion market cap very soon. But we are seeing some serious dumps in the market right now on the back of this rate cut. So yes, everybody joining us in right now, we did get a rate cut, 25 basis points came in, but the markets were obviously expecting 2 more rate cuts in 25. That's exactly what we got, but inflation expectations are certainly higher, significantly higher in 2025 than what was previously proposed by the Fed. 40 basis points higher for headline and 30 basis points higher for core CPI right now is what we have from the Fed. So certainly seeing quite a bit of a revision to the upside for inflation, and fewer rate cuts. Fewer rate cuts is certainly hawkish from the Fed. Jerome Powell can give us a little bit more insight into that in about 20 minutes when the speech actually begins, and we'll be ready to listen in on that. But all in all, I think this was already expected. That was a big revision to the upside, and we're seeing some selling pressure. Now, I definitely want to create some collars for a lot of these positions, like for example, Tesla. I'm very tempted to buy puts on Tesla here in the 420 or 430 puts. Premiums are high for those puts also, especially if I go out let's say 6 months or at least a 1 year out. But I do recommend, at least for myself, collars. Collars are one of the best ways to generate some insurance premiums, like insurance policies, because you've got basically you can sell calls and buy puts at the same time, and you can finance the cost of that put by selling calls in the first place. So sometimes you can create these zero cost collars where you don't really have to pay anything out of pocket to protect your positions. The only problem, of course, is trying to figure out where at what strikes it actually makes sense. So for me, I've sold Tesla calls in the 800s. For those of you who've been following us, been watching the content and are part of our Discord, I've obviously sold calls for Tesla at $800 and $850. So if Tesla gets up to that level by December, that's when I'll get in the money. But until then, I participate all the way up for that capital gain, for that appreciation. But I also want to protect the downside, which is why I've been thinking about buying some puts. So using the premiums that I've collected to buy the puts in the 420s or 430s, 440s, possibly even in the 450s, because that will always give me the right to sell my shares if I wanted to at that specific price. And that's only to protect if Tesla were to, let's say, see a 30 or a 40% correction, or pretty much a sell-off, aggressive sell-off in the future, because this has just been a insane parabolic run-up for Tesla, for Palantir, all the stocks that we discussed in our yesterday's update. And so I think it only makes sense to protect some of those positions. All right, everyone. So we're going to do a quick question. Where are you tuning us this morning for Jerome Powell's speech? So let me know in the chat, where exactly are you joining us from? And I'm really curious, what part of the world are you joining us from? And I'll answer all the questions now, just getting in to all the chat here. So again, shout out to all of you guys. Singapore, Jersey, Austin, Texas, Canada, Lithuania, got Denmark, Ireland, Slovakia. Singapore, it's 3 a.m. Man, props to you guys for staying up. Mark, Dallas, Texas, shout out to you. We got Italy, we got Croatia. Man, that's incredible. So this is what I love. This is what I love reading, where you guys are all joining us from. We got United States, of course, Germany, Argentina, Ukraine, Florida, England. We got someone joining us from Palantir, Hawaii, India. We got Saudi Arabia. That's incredible. Netherlands, Brazil, New York City, Houston, Thailand, Miami, Florida, Orlando, Florida, Georgia. We got Illinois. That's incredible. Do we sell all and buy when Powell talks, Ian? So I wouldn't think of it that way for the market, because again, that's just kind of try to time the market, and nobody is good at that. So I wouldn't recommend you timing the market. I think it's best that you look at your long-term portfolio, and then of course your swing trades and option trades if you're taking those. But in no circumstance, in very rare circumstances, warrants selling your entire portfolio and then running for the hills. But I think 99% of the times you're just not. You're just better off kind of weathering through that entire volatility, because time in the market will certainly be timing the market in any 20-year period, or maybe even 15-year period, because the probability is really high. But run the numbers. Any 15-year rolling period, you're bound to make money. There's a 99% probability that you end up making money over any 15-year period. So Kevin says, not the moon. Come on, Kevin. I mean, you've had an incredible year. You're definitely tuning in from the moon. I think just given how successful this year has been. So Ire, what do you think about gold, XAU after these changes? Would like your comment? So gold, I love. I've been buying gold for a long time. It's a very small part of my portfolio, like less than 1%, but still I've been buying a lot of gold, and I will continue to dollar cost average into it because of a long-term potential that gold has to offer. So yeah, gold, again, I don't mind dollar cost averaging a little bit into it, buying every so often to dollar cost average, and of course diversify a little bit into gold, because it's a very uncorrelated asset class. Of course, it doesn't generate any income, but at the same time, it does give me that uncorrelation where if everything is selling off, gold tends to hold up its value really well. And I'm going to be a little bit more aggressive in 2025 in Bitcoin. I'm just, looking at BITX as one of the potential positions. It's a very, very volatile, very leveraged play. So I think it's really important for everyone to be careful with this one, but I will be a lot more aggressive with Bitcoin in 2025. So that is something that is going to be one of my focuses. And then, of course, a lot of other ideas that we're going to elaborate on and explore together on our private live stream towards the end of this year. So we're going to be doing a live stream for all the members. We're going to be coming together with a notepad, writing down all the different ideas to focus on, all the different stocks to focus on. We're going to make a very, very good exhaustive list of all the stocks that we need to look into for 2025. I think that's going to be super helpful for everyone. It's going to give us an idea. And I'm really going to ask everyone, so all the members need to come prepared, of one stock which is your highest conviction stock in 2025. One stock that you're the most confident on in 2025. So we're going to be doing a very good, detailed, engaged discussion towards the end of this year. And you can really just take a lot from other members and note down some of their highest conviction stocks and do more research on that. Okay, 10th consecutive Dow Jones candle. So that's crazy. I think since 1970s, I think we're seeing the 10th most consecutive red candle here. But let's see. what does the money vest indicator say? Right now it is sitting at around 3.25. So it just got sold off a little bit. So it was sitting at 3.44, now at 3.25. Ihan, so I must sell everything now or wait. Well, it really is your decision, man. I mean, you have to decide what your goal is, what your target is. I mean, I can't really generalize everything and give you any guidance on what to do with your portfolio, but you have to really analyze, what your strategy is, what your time horizon is, what your risk tolerance is. There's a lot of things that you need to discuss before you make a decision like that. When it comes to investing, it's not so black and white. It's not just, oh, you do this or you do that. You have to really analyze your own situation, right? Because just because it works for me or works for someone else doesn't mean it works for you. So everyone has to kind of do this evaluation, of their own portfolio and of their own risk tolerance and timelines and objectives. And, when do you want to retire? How much do you want to spend when you retire? What kind of life do you want? What kind of, place you want to live at? Where do you want to live? Like, all those questions need to be answered to better figure out what your goals are. And then you can try to work backwards and plan out your future. But yes, selling everything, all of it, just because Powell is about to speak, that's certainly not recommended. Something that I've never done. So just take it easy. I mean, this is this normal market volatility, especially when you consider the markets have run up so much this year. And look, we've gone through so much together, right? As a community, we've been doing this for like almost 5 years now, and we've gone through the best and the worst. More worse than the best. 2024 has been very good. It's been a very strong year, but we've gone through, really tough times. I mean, I remember 2020, the March crash. It was brutal. I remember 2022. It was brutal. We saw every single day was red, just like every single day is green this year. Every single day back in 2022 was red, and it was almost every day our live stream was a therapy session, or we're literally just dumping money into a fire pit, and the market just keeps going down. And so, if you're new to the channel, just know that this is normal. This is very normal in the market. And it's certainly not the first or the last time that we go through a correction or a pullback. It's going to happen again. So, guys, I know a lot of you guys are just copying and pasting a lot of these questions. Unfortunately, I'm going to have to remove you from the channel because it's just you're spamming a lot. And just one question at a time, I will definitely get to it. But I just can't stand you guys copying and pasting all these questions. Anyway, so hopefully that answers the question here. Yes, so Blaze says, don't sell everything that's dumb unless it's a short-term gains that you need. Correct. I'm in Lucid Motors. Will I make it in 2025? Sato is asking. So Lucid, I haven't really analyzed Lucid all that much. I think I've done a couple videos on them. I think the path to profitability is very important. So with any company, long term, when it comes to long term investing and, something that you're looking at from a, 5 to 7 year potential, it's really about figuring out the path to profitability. I mean, look at what happened with Palantir. Look at what happened with Tesla. Look at what's happening with SoFi. A lot of these companies are prime example of achieving profitability. Look at what happened with a lot of cybersecurity companies, right? As soon as they turn the corner towards profitability, we see just a whole new institutional involvement in that stock. A lot of big players get involved, a lot of big analysts, Wall Street investors, they start covering that stock. There's a lot of enthusiasm around that company because of the fact that they're actually getting profitable. And so when it comes to Lucid, I think the question you need to ask is there a path to profitability? I mean, every single quarter, the company is losing hundreds of millions of dollars. As much as more recent quarter here, third quarter 24, almost $1 billion of losses. Powell's speech is going to be in about 8 minutes. 8 minutes is when the Powell speech begins. So this right here is a live stream. And we're going to be starting in about 8 minutes here. At 2:30 p.m. Eastern, we'll be listening into what Jay Powell has to say. So yes, it all comes down to profitability. And for Lucid, if they can find a way to turn the corner here, where they're burning through 5 times as much in net losses as they are making in revenue, then it's going to be very difficult to see any type of recovery. Now, there might be some burst of momentum every so often. I mean, this right here is, a 70% rally. This right here is a 58% rally. And this might be a stock that's also heavily shorted, so you might get a little bit of a short squeeze or a technical rebound or something that allows you to, let's say, break even or make some money. But from a long-term perspective, I think it really comes down to the path to profitability. And the company doesn't necessarily have to be profitable right from the beginning. And that's a lesson that I've kind of come around over the years, that I was always very strict about profitability. But with profitability, you also kind of limit on the potential for profit. So there's definitely a trade-off. If you are going with a company that's not profitable, you want to be risking too much, unless, of course, your confidence level is so high that you're like just absolutely 100% confident that they're going to make it. But we're really looking for asymmetric bets. And for Lucid, if you invest in, let's say, $2, and it's a small position for you, you invest like $5,000, and eventually ends up becoming profitable. And it goes from like $2 to $20. That's a 10x, and you make 5 to 50 grand. That's like 1,000% gain. So those type of stories are possible. We've seen a lot of members that's happened with them with Palantir. Palantir is a prime example. Going from like $6 to like $80. That's a 1,200% gain. Tesla, Nvidia, another very good example. SoFi, another good example of how these companies can be multiple baggers. If you're confident enough in their path to profitability. And those are asymmetric bets. We are not investing a whole lot. You're investing a little bit. And then, of course, when they become profitable, there's a lot of coverage, there's a lot of sentiment, a lot of institutional involvement, and then they just blow up. So hopefully that helps you with Lucid a little bit. Caddy, do you see Broadcom at 250, April 2025? Okay, let's take a quick look. So Broadcom, $235 after the split. 250 in April 25. I mean, it was already at 250 earlier this year. It was hitting new all-time highs a couple days ago, but it's also very overbought right now. And valuation, of course, hitting over $1 trillion. But it does need to fill this gap. In my opinion, I think it may come down to fill this gap a little bit here. Got a huge gap in the 180s to 211. So eventually, yes, April 25 is a long, long ways away. But you also have to be a little bit more careful with semis. Semis have been under a lot of pressure, especially when you consider the tariffs on China, the sanctions with China. A lot of these companies not able or allowed to sell some of their higher advanced chips to China. It's definitely restricting their ability to grow. So keep that in mind. Overbought right now, technically, could fill in this gap. But yes, 250 is very much possible. By April, there's a lot of time there. Why BITX and not BITO? The price of BITO is half, which somewhat recreates a 2x move, but at least dramatic speed. Well, not quite. It doesn't work with pricing. It works more about percentages. So BITO, while it is half in terms of price, I mean, a 1%, 2% move is still going to be 1 to 2% move. But with BITX, you're getting more of a leveraged factor, but it's really going to be for, people who want to take that risk. And so that's why I'm really putting up a huge warning sign and cautioning, that if you want to take advantage of this Bitcoin rally and you believe, okay, $250,000 is possible or $500,000 is possible for Bitcoin over the next, let's say, a couple of years. And I was reading a couple posts earlier that the United States is also going to be buying a lot of Bitcoin over the next 5 years. So that is a huge demand factor there. But this is going to be purely played with capital that I'm 100% okay losing. I'm not investing like hundreds of thousands of dollars. If anything, it's going to be like less than 2% position in my portfolio. If it goes down to 0, that's totally fine. If it goes up 500%, that's great. But it is really going to be one of those positions where I just buy and forget. Because Bitcoin, I have no idea how to really value. All I can really bank on is the idea that eventually demand continues to increase and supply, since it's limited, it's going to give us that upside. Now, I did have IBIT. I still actually have IBIT, but again, it's a very small position, but I'm up over 100% on this. Obviously it's gone up from 30 to as much as $60. We've been buying this for a long time. Hindsight 2020 should have been buying a lot more, but whatever I could get, it's done really well. And this was one of the Bitcoin ETFs that we talked about on the channel. So BITX is just a little bit more of a leveraged exposure into Bitcoin. So that's something that I will be focusing on as well. Yes, 2022 was rough. All those buys paid off, though. Kevin says definitely it's been one incredible year, and thank you for the analysis. I went all in because most of my friends have pre-ordered the SUV. We might be in a bubble out here, but I see that as their path to profitability in 500K shares at $2.2. Wow. Okay. I mean, props to that due diligence there, but I would definitely check with a lot of, well, just ask our community. Just ask right now, like how many people actually believe Lucid is going to be profitable in the future, and is it worth buying Lucid? Like, we got over 1,600 people watching. Even if 10% people share their opinions on Lucid, I mean, you've got a good data set of real investors trading with real money, sharing their real thoughts about one company. And so that I think is going to be super powerful for you to take home. And because that's a big investment, man. That's over $1 million right there. You've got 500,000 shares at $2.20. That's over $1 million. So definitely do offer some opinions on Lucid to Sato. I think that's going to be super helpful for him. And so yeah, that's that. And then coming back over to some of the comments here, I was asking about the interesting company XLS. Is it a good company about the stock price? Yeah, so we'll do some analysis on XLS very soon. I see a lot of great questions. IWM, MicroStrategy, Broadcom, Silver. We'll get to all of that. Quantum stocks here. We'll definitely go over all of that. We just have to check in with Jerome Powell first because we got a very important speech here. So we'll listen in to Jay Powell for 45 minutes. And then we'll come back to all these questions. I think that's super important right now. We'll take a look at how the markets end up reacting to what Jay Powell has to say today. So as it stands, the markets here continues to sell off. We're down almost 1%. At the moment, we got the S&P 500 also down about 71 basis points right now. And we've got Tesla a little bit lower, down about 2%, and Palantir still green, however, struggling quite a bit.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smialik with the New York Times. Thank you for taking our questions. I I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point you. There's some language in the in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policy so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought, 2 years ago. But it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices, and that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight, but overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby. Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So, but you're right though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive? So
what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are though in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continued struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand, and it has come down. So we look for signs like that. And that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And, that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and, we want to keep it that way.
Thanks.
Amira. Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and, high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, big real wage increases, so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes? Where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent, and the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation, because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation, because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So that's it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year. Mm-hmm. Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. We're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Man, I was waiting for that meeting to be over because that was not a great meeting at all. First of all, there was a lot of same questions asking the same thing in just a different way. But markets getting absolutely crushed right now. We got over almost $1 trillion worth of sell-off, so $929 billion just disappeared from the market in the last hour since Jerome Powell started talking. If you come over to the Money Vest Index, we're coming down to uncertainty right now. So we're down to low threes again, something that we haven't seen since August 2024. Last time we were down to 3.04. We are right now at 3.09. The question now is, are we going to be trading below that level or not? And if you come over to the market snapshot, this of course is what the heat map looks like. Everything, everywhere that you look, we've got red. With Tesla now almost down 7%, with Amazon down 3%, Microsoft down 2.25%, Google down over 2%, NASDAQ is down a little bit over 2%, and S&P down about 1.5%. He did rule out the possibility of a recession. He did say that we have avoided a recession, and of course continues to be very, very data dependent, that interest rate decisions are going to depend very much on the incoming data for inflation. They are now coming down to some very restrictive levels, with employment being very, very tight. However, the market, of course, doesn't seem to like the fact that we are seeing fewer rate cuts with also a higher inflation expectation. So those are both very hawkish things about the market, which is what's causing this majority of that sell-off, is that we're seeing 2 fewer rate cuts from the Federal Reserve, and inflation expectations are also higher in 2025. And both of that is not a recipe for a very, very quantitative easing market. In other words, very supportive market in 25. So, of course, this is all open to debate for next year, depending on where we are. But the markets certainly are taking a big breather right now. If you come over to the snapshot and come down a little bit, everything just went into a little bit of a pullback or a correction, or mostly in a dip. And Tesla is now officially in a pullback, down over 7.5%. I think it's got an intraday sell-off of now well over 10%, might be more. From its all-time highs of $488 that it hit earlier in the morning, it is now down almost 10% from those levels. So perfect. Thank you so much for joining, everyone. I did mention in my yesterday's update to be prepared, because a day like today was just on the horizon. It was coming, and volatility on, of course, with a huge spike. It's up over 21% right now, trading back up to 19s. However, this is only going to create some buying opportunities. I have increased my cash position. So I've increased my cash exposure quite a bit. So I will be using that very soon as volatility here spikes up to, let's say, in the 20s. Money West Index comes down possibly in the low 3s, possibly sub 3 is what I'll be watching. And then, of course, a lot of individual stocks and indie ETFs are going to start being a very discounted deals once again. So again, join our Discord if you want to get access to all the trade alerts. There is an annual 16% discount that expires at the end of this month. So there's a few more days. If you want to take advantage of that, you get access to the entire MoneyVest website. You can keep track of where the MoneyVest index is, the snapshot, the concentration, the shopping list. So 29 stocks that I believe are super high quality with my buy targets. And again, it's times like these when it becomes very useful. And again, you can join our Discord, get access to all the trade alerts, all the options portfolio updates. Everything is going to be available with the link down below. So happy to have you. Again, thank you so much for joining, everyone. Hope you all enjoyed this live stream. Market update is going to be coming out later today. It's going to be quite an interesting one, so look out for that. And again, link's going to be down below if you want to join our Discord. But this is quite an interesting sell-off here. Tesla's down almost 8%. Palantir is now in the red, down over 1.6. Nvidia is the only stock that is holding up a little bit, still up about 0.5% right now. So, happy investing. I'll see you all in the next live stream. Take care.